Hello everyone, welcome to MEAZ Learning Channel. The topic today we have is do's and don'ts of mutual fund. As with all investments, whether it is mutual fund or any other investment, there is always a do's and don'ts concept for investors. So this is where the do's and don'ts of mutual fund come in the picture. It gives you an idea to the investor what the investor should do, what the investor should not do, what the investor should be known, and what the investor, or again, what are the duties of the investors, what are the responsibilities of the investors, all comes into the concept of do's and don'ts. So there are certain do's and don'ts that every mutual fund investor should know about. The first one, diversify your investor. Do diversify your investments. You're not supposed to put all the eggs in one basket. That's basically what you mean by being diversified in your investments. Spread your risk, achieve a balance, tap into opportunities, invest in a variety of mutual fund across different asset class, industries, regions. Always see that you have a different asset class for mutual fund investments. And you do invest in different wide sectors and themes based on industries. So that your exposure to, even if you are exposed to market volatility, but still there will be a risk mitigation strategy for you, which comes with diversification. Achieve a balance is achieved when you have a well diversified portfolio, ensuring stability and growth in long run. Tap into opportunities. Diversification allows you to capture gains from different market segments. When one scheme is in loss, the other scheme might be in compensate with its profit. So you can always find a balance in your investments, and you can always tap into opportunities if you diversify your investment. So that is what we meant by that. All like investments in mutual fund should be diversified. So do diversify your investments. Do research fund management and fees. Like do research in fund management and fees. So you have to have an understanding of the fee structure of mutual fund, which carefully examine the expense ratio of the mutual fund. What are the charges that they charge for the annual cost? In case your fees is high, then you cannot have a expected rate of returns, because of higher fees, your returns percentage may go low or maybe less. So lower the fees, there will be higher returns over a period of time. Evaluate the fund manager, research about the fund manager, experiences, investment style. Does the investment style align with your investment objectives? What are the track record of the fund manager? But they align with the investment goals and risk tolerances. What is the experience of the fund manager in the market? How well the fund manager manages the crisis in the market or a market condition. All these are very necessary for an investor to understand. Evaluate the fund holdings. What is the composition of the fund, like portfolio? What kind of portfolio the fund offers you? How are they investing the money? What are the sectors, themes they are selecting? And how they are selecting the sectors and themes? What is their strategy in selection of investment avenues of making portfolios? This is also a very important aspect for an investor. So do research about fund managers, management fees, evaluate the fund portfolios of fund holdings. All these are something that a mutual fund investor must do. Start investing early. And they say a mutual fund is as good as you start investing early. So earlier the best, as and how you start investing in mutual fund. Over a period of time, you get a good returns. The concept of start investing early is like as soon as you have all information about the mutual fund area, mutual fund schemes or mutual fund documents, you understood the mutual fund evaluation, then you start with investing in mutual fund. So as early as you invest, you will have better returns. Your investments also compound over a period of time. So longer the investment, higher the compounding factor and the growth in the long-term fund. So harness the compounding factor. Mutual fund always have a compounding factor. That's one of the benefit of mutual fund. Like you don't have a compounding concept in bank investments, banking deposits, but you do have a compounding factor or a compounding investing in mutual fund. So if you start investing, the compounding factor gives you much better returns over a period of time. Consistency is the key. That is where SIP concept comes in. You basically invest systematically. Early the better. Even if you start with a meager sum of 100, over a period of time you can increase your investments from 100 to 500, 500 to 1000, and you can easily harvest a good returns over a period of long term. So this is where consistency comes into the picture, and that is where SIP factor is highlighted in the mutual fund. So consistent investment practically means systematic investment. And to achieve all your financial goals, you have to go by systematic investment. You have to have a disciplined investment. So do start investing early. Do regular review and rebalance of your portfolio. You cannot keep your portfolio inactive for a long period of time because mutual fund is subject to market risk. So as and how the market changes, you also have to change your portfolio. So keep monitoring performances, rebalances or remodel as and how needed, adapt to changes as and how the financial circumstances changes, your risk tolerance changes, your investment goals evolve over a period of time. Do regularly review and rebalance your portfolio. The don'ts that we have to come across in mutual fund as an investor is don't panic during market downturns. As you can see, market is something which is dynamic. It changes every day. There's a lot of volatility in the market. Even a simple stir can cause a turbulence in the market. In a global event can cause a turbulence in the market or can affect a market. And mutual fund practically invest in market. So anything that affects the market also affects mutual fund. So during a market downturn, the most probably you can do is stay calm, take a long-term view, and maintain diversification. So one of the things that the mutual fund investor should always seem to know is don't panic during the market downturns. Don't chase the past performance. It is always a good idea to look into past performances. Take a view of what the past performances was of the scheme, but don't focus on past performances to make investment decisions because there is a dynamism in the market, which over a period of time will change. So you cannot always rely on past performances to understand what the future performances of the mutual fund might be. Focus on the fundamentals, that's more important. If the fundamentals are strong, even if the fund is underperforming right now, it has all chance that it can perform better in future. So understand the fund's investment strategy, risk profile, fees, management team, rather than only relying on historical performances or only relying on past performances. Avoid rumors, avoid speculation. Don't be tempted by the latest hot trends in mutual fund, as often underperformed in long run. So you have to stay focused with the information that is there in the market, the fundamentals of the scheme, and at the same time the past performances. The strong past performances does not guarantee you a future performance of the market, future performance of mutual fund. So that is one thing that the mutual fund investor should not do. Don't chase the past performances. Don't invest funds if you don't understand them. So how do you understand a fund? You understand the fund through its document. You understand the fund through its evaluation. You understand the fund through a fund manager. You understand the fund through investment objectives, strategies, risk, underlying factor. You understand the fund by its portfolios. So if you are unable to understand all this, you better do not invest in that scheme. If the fund is not aligned with your goals, don't invest in the scheme. If you don't understand the investment objectives, risk strategies, seek guidance. Consult a financial advisor who can easily give you a glimpse or a key understanding about the mutual fund schemes. Invest in mutual funds only if you are well aware of its risk, returns, evaluation, performances. Don't invest in schemes that you don't understand. Again, there are many more do's and don'ts. It differs from investor to investor. But the key takeaways from the topic is investing in mutual funds can be a powerful tool for building a long-term wealth. So mutual fund investment is not only for a short-term return, it can basically be for a long-term wealth. So main objective of a mutual fund investor should be not only to have a quick returns, but also to create a long-term wealth. And for doing that, they should always know what are the things that the mutual fund investor should do. and the mutual fund investor is not supposed to do. So the do's and don'ts practically maximize your chances of success. So remember to diversify, remember to research, start early, stay disciplined, and you will be well on your way for achieving your financial goals. Hope you understood the topic. Thank you very much.